Go, Lachlan. How are you?
Good, thank you. How's Luke going?
Good. Yeah. Elbow's healing well. Okay, welcome back. Can you hear me up the back? Great. So we're already in week 4, so 1/3 of the course is just about gone. Today we're going to have a look at a topic that typically hasn't been seen as all that interesting, but in fact it's very interesting, and this is the topic of fixed income securities. I'm going to tell you a little bit about fixed, which no doubt you've heard, so I won't be going so much through the mechanics of it. But I'll put it in a broader context that will allow you, in particular, to relate what we're talking about to issues in the front pages of the newspaper. You'll often hear predictions in the newspaper. We're going to have a recession. There's going to be an economic Armageddon. The world's coming to an end, type of thing, from an economic perspective. And I'm going to give you a framework to help you understand this and put this into some kind of perspective, so you can make a judgment. So the topics I'm going to cover in this lecture is, first of all, is the importance of the bond market. And then we'll go through a brief revision on how bonds are priced and issued. So I'm assuming that we'll be going through that fairly quickly. And that'll take up the first part of this lecture. And then in the latter half, I'll talk about the next question: is the bond market in a bubble? Which, in answering this question, allows you to also address a whole lot of other issues. For example, do we have a housing market crisis? Are we in a housing market bubble? Is it going to crash? Is the economy going to crash? And so we'll have some implications for investors. Should you put your money into bonds, or should you put them into equities? So to give you a sense of importance, the bond market has always been important, and an early indicator of this, actually there's even earlier indicators which I'll come to shortly, but certainly a memorable episode of this is Bill Clinton saying, "You mean to tell me that the success of the economic program and my re-election hinges on the Federal Reserve and a bunch of," I don't know what that word means, of bond traders. And so why is he saying that? It's because in about 1990, he was elected in 1992, and he was looking to get re-elected in 1996. And about that time, he wanted to increase the spending in the economy and run into some deficits, so go into spending more by stimulating the economy. And his advisors were saying, no, if you go too much into deficit, or even if you go into deficit, the bond market will penalize you by raising interest rates. So you better go slowly. So and he's concerned about this because his whole re-election prospects depend on that fiscal spending. So hence the quote over here. And again, James Carville, advisor to Bill Clinton, who's a famously hard man himself, but says, I should think of it as reincarnation. I'd come back as a president or the Pope or a .4 baseball hitter. I guess this means that you hit the baseball 40% of the times you get at bat. But now I want to come as the bond market. You intimidate everyone. But another perhaps, one third one. So Thomas Friedman back in 1995 saying, this is back after the period when the Soviet Union collapsed and we had Russia, and Russia is now a pale echo of its former, well, this is before the Trump administration anyway, didn't have the power it used to have back in the 80s and the 70s and 60s. So there was a decline the US was just the one superpower, but Thomas Friedman says actually we have two superpowers. We have the US and we have Moody's, because Moody's bond rating agency, if it downgrades the ratings of a company's bonds, then the country won't be able to raise money in the international market and they'll suffer the consequences. So there's a powerful economic power there. So the US can destroy a company by leveling it with bonds. The Boonies can destroy it by leveling it with a low rating, bond market rate. But even earlier than that, we have a story here from the Prussian government. So after the Napoleonic Wars, recall that, well, you won't recall if you remember your history, Napoleon was defeated at the Battle of Waterloo in 1815, and that was a coalition of a bunch of European powers, including Prussia and France, well, not France, England, and they had all taken up a whole lot of war bonds to finance the war effort against Napoleon. And now the Prussian government, its coffers having been depleted, wanted to go back to the market. It didn't want to raise its own money from within Germany, because that would mean that the Prussian king would have to call back the principalities, the people who make up the states, and re-elect a more democratic form of government. So they decided to raise the money overseas. But then they ran into Nathan Rothschild, the founder of the famous Rothschild family banking dynasty, who said, well, that's fine, but if you want to do that, you'll have to offer the land as security. In other words, your word isn't good enough, but you'll have to offer the country as security. Because the investors preferred a representative government as opposed to the absolute government, which was the Russian Tsar. Now the point here being, so here's Nathan Rothschild, a banker. This country is just, Prussia, has just won this war against Napoleon. And he's coolly telling them, well, you won the war, okay, that's fine. But if you want money, you'll have to offer your land as a guarantee, as security. So that's the power of the bond market, even back in the 19th century. So we have similarly over here, so this is all about emphasizing the bond market, and we have, this is the kind of story you'll read if you read the press, or the financial press at least. It says there's 250 million in debt. Lehman Brothers was the investment bank, the long centuries-old investment bank that collapsed and triggered the global financial crisis. A large part of the crisis was thought to be to the incurrence of debt in the world. And I'll talk a bit more about that when we talk about financial crisis. But over here, Brian Chapata is pointing out that since then, the market has gone up to 250 trillion in debt. So the world's debt burden has ballooned to almost 250 from about, I haven't got the value over here, but it was about 52 million before that. So if we were in trouble before the financial crisis, his point is we're in much more trouble now. And that's caused, so the result of all this money flowing in, all this credit being allowed into the market, the point has been made, has created a massive credit bubble. In other words, you'll recall from last week or the week before, a low interest rates causes asset prices to go up. So as a result of the governments releasing money into the system, helping inflate this massive credit, increase a flood of money into a whole lot of valuations in the market, asset valuations have gone up. And the point of this article is that when interest rates go up, then the financial crisis will look like kids' play compared to what the kind of consequences we can expect now. So that's the kind, so how do you analyze this? How do you assess, is this right? Are they saying, is what they're saying reasonable? Or if it's reasonable, is it likely? That's the kind of thing that you have to address as an investment analyst. And so closer to home, that's a global crisis, but so closer to home, the Crikey, which is an independent newsletter, says, forget Federal Treasurer Josh Frydenberg, the housing bubble needs to burst. So Josh Frydenberg is pointing out that we should be careful, not let the housing prices down too much. But they're saying the housing market is long overdue for some creative destruction. The question is when it will occur. Again, this is the kind of, I'll see this and I'll talk about this, I'll make frequent reference to this. This is the kind of tough, pointless talk that people often engage in financial markets. So prices have gone up and they think they're too high and therefore they should come down and people will really deserve what they get, and because they were just so silly and they don't deserve for these asset prices to go up. There's no particular point to it, it's just some kind of petty meanness or in a way to make themselves feel better about this. Which doesn't mean it can't be true, but A, it's not true, and B, I just don't see the point if it is, why people have to take on this kind of an attitude. So again, The Guardian, which is another journal, which often talks, it seems to take fun at any, doesn't seem to have much confidence in any market-based outcome, but they say Australian house prices are falling at the fastest rate in a decade. The Sydney and Melbourne properties have now dropped 11 and 7.2% respectively. So which suggests that perhaps the bubble is bursting. But will it actually drop a lot more? Which is a kind of a personal question for you, because if you are thinking of going to the housing market, should you buy now or should you wait? So let's take a step back in evaluating this by looking at the bond market, looking at the investing context and some broad features. So taking one step back, the ideal investment that you want is something with high return, low risk, it maintains its value over time, and it's highly liquid and widely traded. In other words, you buy it, it gives you a high return, it keeps its value, and any time you want to buy and sell it, you want to exchange it, it's there. That's the ideal investment. Now you want that thing, and so does everyone else. And because if you've got a bond, if you've got an asset with that kind of attribute, if it's low risk and highly liquid, everyone else will want it. So let's say it's got a high level of profit now. When you buy that, so you'll buy it, and other people will have the same, they're the same as you, they'll see it, they'll buy it, the price will go up. When the price goes up, the returns go down. So if you buy something with that's got a profit of, say, $20, and the share is currently trading at 100, you think, oh, $20 profit, $100, I get a 20% return. If everyone else thinks that's attractive, they buy it, the demand takes the price up to 200, say. Then it becomes a 10% return, $20 over 200. So that's the way it works. So when I say in actual market, no asset has all these characteristics, it doesn't have these characteristics because we deem it so. It's because of the natural operation of supply and demand. To get a high return, generally you need to accept risk and or low liquidity. If you can find all three, great, but good luck. But in normal, efficient markets, you have to have some kind of a trade-off. So the point here is bonds are assets that have low risk, generally a high liquidity, but in return they get a lower return. So now the kind of thing I want you to think about, and I'll return to this question later, is why would someone trade off higher return for an asset with lower risk and lower? What kind of a mindset must this person have? So the question you have to ask is, I'll come back to that, but the question that we have to ask here is, what proportion of your portfolio should you allocate to equities, which are high risk, and bonds, which are low risk? Equities have high risk, therefore higher expected return. Bonds have lower risk, lower expected return. So this is the asset allocation process. And what it says is very true. The sector in which you allocate your assets makes more difference than the specific securities that you buy within that portfolio. What he means by that is whether or not you're invested in equities or the Australian share market matters more for your total overall returns than whether you're buying particular companies within that portfolio. So whether you buy BHP, the banks or whatever is less important. That stock selection process is less important than being invested in the stock market at all. So it's more important, and Pius and his correct, asset allocation is far more important than picking stocks. And I'll come again to this point when we talk about the efficient market or portfolio theory next week. So, as an investor, typically invest more in bonds, because as you're older, you'll need less risk, given that you don't have that much more time to save up or invest till you need it. So, the general advice is, when you're younger, invest a higher proportion in stocks. As you're older, you invest a higher proportion in bonds. But, what do the greats think? And so from today's paper, we have Moelis John Garrett saying he's looked this up for us. He runs an online blog, and Investing compiles thousands of quotes from the world's greatest investors, including Warren Buffett. And Warren Buffett every year has an annual meeting in Nevada, Omaha. I forget what the city is called, but it's a small little city in Omaha, in Nebraska. I'm not sure, one of those two states. Anyway, thousands of people go there, and this time this Garrett is taking his son back again, for his 14-year-old son, for the ride. There's one point I want to make about this. And if you're investing in the market, one reason why people invest in the market is that there's a divergence of opinion. If there wasn't a divergence of opinion, people wouldn't invest in the market at all. So for you to expect to be consistently right, you're battling against a whole bunch of other people all of the time. And how likely is it that you'll be right any of that time? Not very. So people say, well, if it's possible, if I just follow Warren Buffett, that should be okay. Maybe that's the way to invest. So again, I'll come back to that when it talks about market efficiency. But in the meantime, let's see what is Warren Buffett's asset allocation strategy. So he's now has $109 billion in cash, his company, Berkshire Hathaway. And he's investing very little in long-term bonds and other interest rate securities. He's preferring to keep his money in cash equivalents and short-term US Treasury bills. So what he says is, in his 2003 annual report, and he hasn't changed his mind, I don't believe, he says, for his wife, if he dies before his wife, he says, put 90% of the cash in short-term government bonds and 90% in a very low-cost S&P index fund. In other words, don't give it to an active fund manager, put it in an index fund. And he says the long-term results will be superior to those obtained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. This is probably the best advice you could have, the best practical advice they could put to immediate use. When you're buying anything, to work out, have a look at the contract and work out whether really you're buying all that, what you're spending is worth what you're getting. Let me give you one example from, now in giving this example, I'm mindful of a quote from UWA Confessions which said 60% of business lectures are just anecdotes, 40% are content. I try to keep my personal anecdote to a minimum. But as an example here, I went to Telstra yesterday, and my phone needs renewing. I pay $59 for a 2-year-old plan. And I thought naively that I had to buy another phone and go to another plan. Luckily, I took a friend along to me and said, "Are you happy with your phone?" I said, "Yeah, I don't know to change it." He said, "You use your phone so little, just go and buy a $10 plan." I said, "Oh, really? I can do that?" I said, "Yeah, you can. You can't come away from the shop, from the Telstra shop. Go to this other place and book online, and the thing is called belong.com, and I can get a better plan." So this saved me immediately $60 minus 10, $50. I looked at my health plan the other day. I cut it in half just by putting out all the stuff that I didn't really need, like pregnancy. It turns out I was paying for pregnancy coverage. But so those kind of things, they'll be, if you look at these kind of contracts, you buy Apple, for instance, that's another thing. You pay Apple subscribe. How often do you use it? But they'll keep on ticking over every year. So you can clean up your cash flow or increase your cash flow very easily by just reviewing the contracts that you've got into. Anyway, I'll stop. Let's go back to this thing. how has Warren Buffett's advice panned out in terms of investing in stocks versus bonds? So what we see here is that the data are exactly as theory would predict. Equities, over the long term, get higher return for lower risk. Government bonds get higher, again, slightly higher return than bank deposits. Why are bank deposits a bit lower? You would think government bonds are risk-free, that the credit is 100%. But with bank deposits, you're guaranteed very high liquidity. You can take your money out any time you like, and so that makes it, that costs you. The ability to take your money out means that you get a lower return for that. So, this thing's, look, in terms of this graph, this seems fairly good. Why would anyone invest in government bonds? The difference is quite stark. This is something you've got to be careful of when you're looking at graphs that are presented to you by financial advisors. The scale really makes a difference. This is perfectly accurate, but looking at it, it seems, my God, equities for me, always. Except that, see that dip over here? Or that dip over there? That doesn't seem so prominent. So if you look at the total return of this, so here you've got the US Treasury, here you've got the S&P accumulation index, you see that over this long period, stocks have indeed outperformed, but you've had a period here where there was a substantial decline. And you don't see the same volatility in either the US Treasury bills or the bond index. So it's much less volatile. So it's the prospect of a sudden drop over here, which is what makes stocks, equities risky. So when you look at this in Australia, we have, you see that most of in the financial market as a proportion of GDP, we have an unusual situation relative to the rest of the world in that we invest more in equities relative to corporate bonds or government securities. The rest of the world is much more risk averse. In the rest of the world, you can see this is the fixed income markets, that's the size, and these are the equity markets. Most of the world prefers to have money, most of the world is risk averse, so they prefer to invest in equity and bonds, fixed income securities, rather than in equity markets. Right, so let's just talk about the mechanics. I won't spend a lot of time here because, again, I'm sure you've come across this in your earlier units. But fixed securities are a promise to pay a defined stream of income over a fixed number of periods, with a repayment of principal at the end. Now, this is the thing. The nominal payments are fixed, but if inflation is really high or is different to what is expected, your real return is different. So if the government issues a one-year security promising to pay $5 plus the face value of the bond at the end of the year, what happens if the investors require 5% for risk-free assets? The government will receive $100. Right? So if investors require 10%, but they're only promising to repay $100 at the end of the year, then the government will receive $95.45. Because $5 over 95.5 is 10%. So they'll get the $5 interest plus the $4.55 capital appreciation to make a 10% return on $95.45. That earlier point I made was wrong. $5 over 5 is not 10%. So the analysis of bonds then is mostly about predicting changes in expected return. A change in expected return will cause a change in price. Now this is one of those things that is simple to tell you, but actually it's quite difficult to understand. And I'll give you an example of how it's difficult. But if the interest rates go down, this means that bond prices go up. If interest rates go up, bond prices go down. If credit increases, so if there's a risk of a bond increases, the price goes down, it becomes less attractive, so the price goes down. If the perceived risk goes down, the bond price goes up. It becomes more attractive to people. So if you're struggling with that concept, here's something that'll make you feel better. So Peter Costello is a former Australian politician and lawyer who served as a treasurer in the Australian Howard government. He was the longest serving treasurer in Australia's history, and he was also voted once deservedly the Treasurer of the Year by Eurobank. So he tells an interesting story by his son's Year 12 economics exam. His son was studying for his Year 12 economics exams. He asked to help with one of the questions in his textbooks, whether the Reserve Bank would have to buy or sell securities if it wanted to raise the cash rate. So that's an interesting question. Would the Reserve Bank have to buy or sell? So he says, he's the treasurer, his son asks him, and he says, buy. The son says, well, the book says sell. Which makes you wonder, why did the son ask the father if the book said the new? So I told him I was meeting the governor next day and we'd check. So I said, Governor, if you wanted to raise the cash rate, would you buy or sell securities? Buy, he said. No, sell, said his head of securities. So eventually the government said, in practice, we just announce it. So it turns out that's actually the way it happens. When they want to change the interest rates, the government just says, the interest rate's going up. You start charging 100, and the banks follow. They don't buy or sell anything. So I don't know how he went in his exam, but hopefully okay. So the main types of bonds, there's the government bonds, bank bonds, and corporate bonds. And then there are asset-backed securities, and those are the interesting kind. So the government bonds then are risk-free if they're issued in their own country's currency. Now this is really interesting. If a bank is issued it's risk-free and it's issued in its own country, is interesting, it can't default. Anytime it issues a loan and people buy it, it can repay it by issuing more money. So we've come up now with some people are saying, if this is the case, as long as people are willing to accept the money, banks you can finance what you like. So if the economy is in a hole, there's not enough demand, interest rates are low, the banks ought to simply print more money. The government ought to do that. That's what's known as modern monetary theory. So it's a view that that the government bonds, given that people are willing to accept it, and given that inflation is low, then if interest rates are also low, it suggests that there's not enough demand in the market, so therefore the government should simply issue more bonds. That sounds radical, right? But that's what... so people like Bernie Sanders, a potential candidate for the US presidency, his top economic advisor is saying that's what the government should do. Bank bonds are, again, you can raise capital by selling bonds, use proceeds, so banks guarantees the payment to the bondholders. So obviously the risk of the bonds depend on people's credit assessment of the banks. And corporate bonds, which are more common in the US, are not so widely used elsewhere in the world. The next class of asset is an asset-backed security. These are the kind of bonds that caused the financial crisis. So and I'll go through this a bit quicker than you would, but I've got an explainer in the recommended readings. But in this case here, you have, how does this work? You have a financial intermediary, a bank. He lends money to borrowers to allow them to purchase an asset. So this is you taking out a mortgage and you go to a bank. So the loan is made to the borrowers and there's an asset in the balance sheet of the financial intermediary. The financial intermediary then doesn't hold the asset, it sells them on. It's got a debt owing to it, so that's an asset in its book. It sells that to another financial company, another intermediary, who collects all of these assets. So basically they collect all the debt in a pool, and when that money comes in, that becomes a stream of income. And that income then becomes the basis for issuing bonds to the public. You sell bonds to the public, and they'll be financed by this stream of income from this debt, with the underlying assets used as collateral. So the loans are sold to investors wishing to buy the income stream from the payments made by the borrowers, and the assets are used as the collateral. So the risks then is borne by the investors who brought the loans from the financial intermediary. Now the thing is, if you're buying a whole lot of liabilities, you need to know how creditworthy they are. So this is the role played by the debt rating agencies. The debt rating agencies facilitated this market by telling people this is a risky loan, or rated the loan according to AAA, very safe, or BBB, which is not safe at all. The companies paid for their securities to be rated, and so there was some conflict of interest here, and I'll talk a bit more about that later. But this is basically the cause of the financial crisis, which was that loans were given out on the basis of credit ratings that had no link to reality. In other words, good loans, bad loans were rated too high. Now my guess is that you've heard, if you're an investor, you're probably investing in the equity market, but has anyone investing in the bond market? No. In all my years of giving, I've not met any student who said, put up their hand and said yes. But a fair few students have put up their hand in the equity market. So why don't they pour more attention? Because the bonds are typically sold in large parcels. They're sold in over-the-counter via an agent, not so much in trading, easily traded like stocks on the ASX. But also, there's less volatility in return. They're less interesting. What makes investing in the stock market interesting is the prospect of making a quick return, less so the quick loss. But that's what gives it the volatility. So if there's no volatility, then it's less interesting for investors. So globally, bonds account for nearly twice as much investment as equity, but in Australia it's unusual, where the bond market is about the size of the equity market. And here you can see this volatility, the blue, the total return, and the bond index just going along over here. Not so much volatility, not so much up and down. For most of the years then, the bond market was fairly boring, as this quote shows over here. So this was a bond trader back in the 70s, wasn't considered a very exciting job, and it didn't pay a lot because you were just buying and selling the securities with a fixed income. There wasn't much margin. There wasn't any advice you had to give. So, and this person had a job as a bond trader and then a train conductor at night. What changed was the advent of the fixed asset-backed securities. The bond market became much more interesting as a result of that. And so it opened up a whole new stream of capital raising. And one person who profited the most from this is Bill Gross. So Bill Gross was one of the early pioneered active trading in bonds. It says he'll retire. This was in February, ending the attempts to reclaim the stature enjoyed as the world's largest fixed income investing firm. In fact, his net worth from June last year dropped by $1 billion. He had $2.5 billion, now he's only got $1.5 billion because he's just unable to compete in this particular market. The question is, why was he so successful? Was he successful because he was particularly brilliant, or was he successful because he had any deep insights, or because he got into the market in a big way and was able to capture 3 decades of falling interest rates? So we've had this remarkable period over the past 30 years where interest rates have kept on coming down. And over that period, if you're a bond investor, just by investing in bonds, with the interest rates coming down, remember, interest rates go down, bond prices go up. You'd have made phenomenal returns. That's now come to an end. I mean, we're close to zero, or we are at zero, so it's hard for interest rates to do anything now. Which is why he's been struggling to invest. So how does a bond fund work? So the question is, how does a bond fund comprising securities that say 2.75 get a return of 11%? So UBS head of fixed income, Anne Anderson, has a chirp in her voice as she lists the way active fund managers can squeeze returns out of trading the income securities around the world. It's a piece of cake, she says. So what you need here is you trade to capture the capital appreciation. And I've got the reading for this in the week 4 site. And let me go through each of these strategies. So interest rate changes affect the price of a bond. So one way you time this is that if you think there's going to be an interest rate change, then you buy or sell bonds with a longer duration, because the bonds with a longer duration are the ones that are going to be more affected by a change in interest rate. So to give you a sense of this, let's say you have a bond with a 1-year maturity and a 2-year maturity. If the interest rates are currently 5%, with a 1-year maturity, the bond would trade at $95.24. With a 2-year maturity, the bond will trade with a price of $90.7. Right. Now let's say interest rates go up from 5% to 10%. Interest rates go up, bond prices go down. The bond will decline from $95.24 for the 1-year maturity to $90.91. You're going to sustain a loss of 4.5%. On the 2-year maturity, the price will decline from 90.7 to 82.64. That's a decline of 8.88%. So you can see that by buying or selling long-term bonds, you get you get more exposure to changes in value. So so depending on how confident you are in your predictions about the way interest rates will change, that will determine whether they go into a longer duration bond or a shorter duration bond. Another one is to anticipate the yield curve. So this is a question I'd like you to ask. If you're lending $100,000 to a business for 1 year at 12%, would you charge a different rate if the business wished to borrow for 2 years? And if so, would the interest rate for the 2-year loan be less than or equal to 12%? Yeah. Okay. So, all right. So now the interesting thing here, there's no right or wrong answer to this one. You could quite rationally charge a high interest rate or a low interest rate. The question is, why? So let me walk you through this. You've got a business that says, I'd like to borrow for 1 year, and you say, fine, 12%. And then he says, oh, okay, but I need the money for 2 years. So you say, oh, 2 years. So same rate. And you say, no. You want it for 2 years? You're locking my money up for 2 years. I want 14%. Why? This is what? Well, 1 year, you're giving me, your credit, I'm giving it to you on credit for 12 months. The other is 2 years. More risk. I'm exposed to more risk. But there's also another reason. Not only that, I'm expecting the economy to pick up. And because I'm expecting the economy to pick up, I'm expecting there's going to be greater demand for my money. So if I'm tying up my money for you for 2 years, I want to get a compensation for the higher demand I'm expecting in the future. So 14%, take it or leave it. On the other hand, he might come to you and you might say 12% for 1 year, and he says, but I want to borrow it for 2 years. And you can say, oh great, that's so good. Here, I'll even give you a discount, 10%. If you want to borrow it for 2 years, you can actually. And he says, why? It's very kind of you. And what you say is, oh, it's okay, I'm a good guy. And you're a good guy. We're friends. That's why I'm doing it. That could be one of the reasons. But it could also be because he's expecting the market to go in a recession. So by the end of the 12 months, he's got to reinvest the money again. And he mightn't be able to lend it at 12% or even 10%. He might have to lend it at 8%. So the duration tells you something about expectations. If you're expecting good times ahead, so if you're buying a 10-year bond, looking at the interest rate tells you something about the market's expectations about future economic activity. That's the... Okay, so the next thing we'll look at is, are bonds in a bubble? So we'll look at the pricing of bonds. So this is the clip going back to 2016. Is the bond market in a bubble? Alan Greenspan, the former US Federal Treasurer, says there are two bubbles, or in stocks and in bonds. And he says more ominously, we're in a bond market bubble that's beginning to unwind. And so from here, what cheap money bubbles at risk of bursting. So this is, I just picked this more or less at random. You can get this kind of thing in the paper anytime, but so I picked 21st of February. So it says cheap money has pushed companies into, such as US co-working space provider WeWork and ride-sharing firm Uber, into bubble territory. That's the view of Chris Watling of Longview Economics. WeWork should not be worth 20 billion. Uber should not be worth 120 billion. Tesla is a company that would not exist in the 1980s when there were proper bond vigilantes. In other words, people who were paying attention to the bond market and not letting the bond prices go so high. There's a bubble, and I think it's starting to... You have to keep valuing things up or it doesn't work. And he says, going on, as trifecta of factors in the last few decades has led to serial bubble blowing. Together, these factors combined to allow central banks to create tons of money. So there's the sense that the world is being irresponsible. The banks are creating, these sober international central bankers are creating tons of money, being irresponsible, and which has caused the lending to expand from 5 trillion to 20 trillion in the past decade. The more money you create, the more you create debt and liquidity, and the more you create the debt super cycle and bubbles. So let's go back to what the great man thinks. What does Warren Buffett think? He says it's right. We've got a treasury bubble. So this should really scare us, this. Warren Buffett himself. He's saying that worried investors are making a costly mistake by buying up US treasuries that yield almost nothing. Can't they see this? What's the matter with them? There's nothing. You're getting 0%, effectively close to zero interest rates, and they're buying this. So he said they're going to jumpstart by lowering interest rates. They want to jumpstart an economy and this will likely spur an onslaught of inflation, an enemy of fixed income investors. When the financial history of this decade was written, it will surely speak of the internet bubble of the late 90s and the housing bubble of the early 2000s. But the US Treasury bond bubble of late 2008 may be regarded as almost equally extraordinary. This was written in 2009, 10 years ago. Where's the bubble? What were you doing in 2009? So you're 20, you were 10. Where's the inflation? Okay, before I want to ask you something. Let's just talk about bubbles. Is this a bubble? So the price went up from 2004, it was $38, it went up to 2007, 197, and now it went down. Is this a bubble? Who thinks it's a bubble? Who thinks it's not a bubble? And why? What is a bubble? Let's define a bubble. Tell you what, take a break and come back at, we'll come back at 5:02 and then tell me what you think a bubble is. Okay, so I looked up, has someone got a definition of a bubble for me? Oh, great.
Could you say it's a rising asset prices due to speculation?
Okay, rising asset prices due to speculation. And what's bad about speculation, though? What's
Well, it's people who see increases in value without examining the underlying causes of that value. They assume that increases in value will persist without really understanding why.
Okay, so this is where people will buy on speculation, assuming that values will increase without understanding why. I'll just, right. So understanding seems to be important. Let me go to a definition that we have from here, Wikipedia. That's a good source. It actually is not a bad source. I use it for a lot of stuff. An economic bubble or asset bubble is a trade in an asset at a price or price range that strongly exceeds the asset's intrinsic value. Intrinsic value. It could also be described as a situation in which asset prices appear to be based on implausible, inconsistent views about the future. All right. So the fact that a price goes up and it goes down, is that a sign of a bubble? So can you tell from this that this is a bubble or not? What further information do you need to tell that this is a bubble or not? Do you think Australian share prices, housing prices are in a bubble? Who thinks Australian share prices, housing prices are in a bubble? Yeah, why? Thanks for putting it. That's good.
Well, what we're talking about, the really cheap credit. So you have, and in the Royal Commission, you saw that the banks were lending to people on like huge mortgages. So you've got this huge influx of demand, which is the housing market,
Right.
which has pushed prices up to unsustainable levels. And
Okay.
people buying like apartments off the plan and hoping to flip them once they're constructed. So
Yeah.
it's pure speculative behavior.
So this is the behavior here, that people buying on the basis that they expect prices will increase without really understanding. So that's the, okay. So that describes the nature of the mechanism, that it's, you know. So, I'll come back to that definition, but whether this is a bubble or not, this is actually the price of iron ore. Iron ore went up from $25 in 1998 to, it stayed about that price, and then to $197, then plunged, went up, and now it's about $75 there. So, was that a bubble? It was driven by demand from China, and then the price dropped, and as the price went up, there was an increase in supply, and the increase of supply brought the price down. So it's all explained by supply and demand. Not many people talk about this as a bubble. And so partly because it seems, these are big boys or girls playing in this market. They seem sensible. They might have got the price wrong or something, but it's easily explained by supply and demand. But the housing market is different. So I'll come back to that in talking about bubbles, but here we talk about the compounded value of the US 100 invested in 1928 in respectively the S&P 500 index, 10-year US Treasury bonds, and 3 months Treasury bills. So you can see here the return is really quite phenomenal. If you invested in equities, your return would be close to $400,000, whereas if you invested in 10-year Treasury bonds, it would just be $7,000, and the 3-month US Treasury bills would be $2,000. In other words, is this a sign of an efficient market? Yes, it simply tells us that the people who invested in 3-month US Treasury bills really, really valued liquidity. That's why they bought. That's why they're willing to tolerate such a low return. So there's a good perspective on the issue of bubbles by Guy Debelle. He doesn't talk explicitly about bubbles, but this is the kind of perspective I want you to I think is a helpful framework. I always talk about the kind of a framework that you should evaluate this, and here's this framework exactly, put up by him in a speech. So he says, one of the main points I'd like to make is that the low interest rate structure underpins many asset prices. And that is absolutely right. When you have low interest rates, as we saw last week, it causes an increase in the share price. That is, asset prices which might look expensive are more reasonably priced given that the current rate structure is at historically low levels. And this is the bit that people get hung up over. Everyone agrees that asset prices are propped up by low interest rates. The question is, do we expect this to continue in the future? How plausible is it to expect interest rates to remain low into the future? Will the current rate structure remain at the current levels, or will it return to the higher levels we have seen in the past? So he says, if the structure remains near historical lows, then valuations can persist, but if it rises, then asset valuations will be reassessed. But given that interest rates are low, it's perfectly sensible for asset prices to be high. It's the demand. Low interest rates fuels, increases the supply of money, of credit available, and people use that to buy assets. So there's nothing irrational or, in some senses, bubbly about that in that way. But, and this is the key point, he says, what is the risk that such a shift in the rate structure occurs, and am I being adequately compensated for that risk? So this is the big question that when we talk about global and economic meltdown, the global economic meltdown scenario is predicated on interest rates rising or inflation rising, and therefore nominal interest rates going up and asset prices crashing. When that happens, the people who are in debt won't be able to repay. If they don't have the cash flows, they won't be able to repay their debt, and that's when we'll have the economic meltdown. But the question is, how likely is this going to occur? And so one thing that you need to consider about is, can the right answer be known with confidence? You'll often have people in the press, and when you think about the market for the press, you've got a view, you've got a fairly, his Guy Debelle's giving this fairly reasonable, sensible view. It makes the headlines because he is the deputy governor, but it doesn't make anywhere near the headlines as someone saying, I expect economic Armageddon. The world is just full of cheap money, the central banks are fueling this, and it's all going to go to hell in a handbasket. That makes much more press, more exciting press coverage, whereas a reasonable view doesn't. So that's what gets the media. So if you're a pundit and you want to be quoted in the paper, it's best to state your view confidently rather than to, right or wrong, rather than to be kind of modulated. But as an investor, I think the view here you need is the argument that President Obama pointed out. He says, so here's the president, and he says, nothing comes to my desk that is perfectly solvable, and this is true. So if you're a CEO of a company and your deputy comes to you and says, I've got this problem, can you solve it? And you're able to give him a really good answer. No, it's just the way you do it. You then have two problems. So if someone comes up to you, so let me just put the scenario again. If you're the CEO of a company and you have a deputy running the company, and he comes up to you a few times with his problems and says, can you solve this? And you happen to be able to solve it, to have the ability to solve it. I'm saying you actually have two problems. One problem is solving it, just fixing it up and pointing it out to him, and the other one is finding a replacement. Because if you have a deputy who comes to you with problems that can be solved easily, you haven't got the right person. Your job the deputy has to come to you with problems that aren't really all that resolvable. That's why you're the CEO. So his point is, it's got a perfectly valid point. If a problem was easily resolved, his deputies would be able to resolve it. So as a CEO, what you have to do is dealing with probabilities, exercising judgment. So any decision you make, you'll wind up with a 40 to 30% chance that it isn't going to work. And it says you have to own that and feel comfortable with the way you make that decision. You can't be paralyzed by the fact it might not work out. And that is actually true for investing. I'm going to give you a framework to analyze this, but I can't give you the answer because ultimately it depends on a sense of judgment that you have to develop. So if in an efficient market, you think about this as an efficient market, other people have looked at this particular problem before you. If the problem was easily identified and a solution could be had, they would have priced the asset perfectly. There'd be no profit-making opportunities. There's only a profit-making opportunities in those places where things are uncertain. You have to exercise some judgment, and there's a significant chance that you will be wrong. Because if there's an easy solution, someone else would have come up to it already. So it says, going back to this, there are two bubbles. Now we're in a bond market bubble that's beginning to unwind. Now, his age, he's an old man, and I don't think that's irrelevant. It's a relevant point because as an old man, his life experience is mostly based on his views, or his views are mostly based on his life experience before 1983. I mean, he was old back then. He was about 60 back then. So in that time, he'd be used to interest rates that were at historic, much, much higher than these extraordinarily low interest rates that we're experiencing now. So from his perspective, he's thinking, and he's been fighting inflation for most of his career. In fact, he's famous for fighting inflation. He's thinking, these are very low interest rates. Inflation is not being priced in. With this money being put into the market, we can expect inflation to come up, and therefore, we'll have the problem that I was hired to fight back in 1983. But you can see here that for the past over 30 years, you've got close to a significant decline in US Treasury yields. There. So the 10-year government bonds in the part reflect long-term bonds have also declined. 10-year government bonds, including Germany, Japan, and Switzerland, have been negative at various times. In 2015, over 14 trillion of sovereign paper had negative yields. So for the past decade, and he wrote this last year, the yield structure in the US has been lower than at any time previously. The current excitement about the 10-year yield in the US reaching 3%. In the 3 decades prior to 2007, the low point of the yield was 3.11%. What's this telling us? So last year, the 10-year yields on Treasury bonds was 3%. It's now declined to 2.56%. What does that mean? It means that people have suddenly decided, 10-year, or not suddenly, have over that time decided, government bonds are attractive. But why have they said that? They've said it because they can't think the alternatives aren't that attractive. There must be a lot of fear there about lack of demand. So this notion that there is any inflation isn't borne out by the facts. Otherwise, the yields wouldn't be trending down, if anything. What we have here is a lack of demand. So you see that financial market volatility is quite stable. So to answer that question, why are bond yields so low? Because if they're higher, this is where that thing So this is the question we need to ask. Why are they low? Because if they start going up, that's when we'll have high interest rates with the decrease in asset prices. So interest rates, as I said, are a function of demand and supply. Demand for cash depends on investment opportunities. And there's aggregate demand for goods and services low, so companies don't invest because they fear there is insufficient demand. So really the fundamental problem that we have in the world isn't so much asset inflation, but the lack of demand, aggregate demand. So there's a large, and this is what people still don't understand, but some contributing factors is that the large-scale outsourcing of goods and services and more efficient use of capital has increased capital inequality. In other words, to make a given level of goods, you need fewer people and therefore a lot more unemployment or underemployment of capital. Plus, the aging population has reduced overall demand. If your grandparents, perhaps, they'd be consuming a lot less than you are, simply because of the function where they are. They've paid off their house, they've got a car, they don't need a phone or whatever. So they're simply not spending as much as you get older. So this is an interesting thesis, which I've put a reading for you over here. But so one reason for the fall in demand. So this thesis, this economist, Robert Gordon, has said the rise and fall of American growth, and he's pointing out why there's been a decline in growth. He says there's been a decline in growth simply because the big improvements in the economy, the efficiencies, are no longer there. In the early part of the last century, in the early part of the 20th century, we had massive changes, increases in material well-being and in health that caused an explosion in productivity. The further changes that we have now are nothing compared to the prior changes. So he says, is life much different from today from 50 years ago? Now, this is the phone from 50 years. This is the iPhone. I actually remember this. When I was 6 years old in Africa, I remember we used to have a wind-up phone, and you'd wind it up and the telephone operator would call. So So his point is that things haven't changed that much, and so although we have all these improvements, we think life has changed dramatically. You might think the iPhone is a big difference and it is a big change over this phone, but really in terms of orders of magnitude, it hasn't improved a quality of life so much. And he makes this point by saying, if you go to the house in the 50s, in the 1950s, the US house, it'll be different in some respects, but you'll still be able to live fairly comfortable. It won't be that much of a change in your standard of living. Whereas you go back to the house 50 years before that, life would be completely different. So again, we see this evidence that because there's a lack of demand, the companies are doing reasonably well, but they don't have anything to spend it on. So corporate cash holdings have hit record highs. In other words, if they've hit record highs, there's no need for them to borrow money. And so you say that cash-rich companies are weighed down by their cash. 32 companies have 57 billion in cash reserves. So these are the biggest companies. They can't find things to invest in, profitable investments, because there's just a lack of aggregate demand. And Europe, again, the ratio of short-term cash at hand to debt has risen 2 times to the UK and 1.1 times in Europe, above the respective 1.5 and 0.9 times averages since 1955. And this is the key thing. Corporate chiefs also need greater confidence that new investments will generate adequate return. So a good question to ask here is, okay, if times are so if there's not enough demand in the economy, we have seen for the past 10 years a big winning streak in the share market. In fact, this is one of the longest periods of booms in the stock market. So why is this? And it's mainly because the large companies, this is driven by the very large companies. It's not driven by the smaller companies, it's the very large companies that are driving this. And here you can see this. The stock market rally has everything except investors. And this is from the New York Times. The S&P 500 has risen more than 300% since March 2009. But every year since then, money has flowed out of market mutual funds and exchange-traded funds. These investors, overwhelmingly individuals, have moved into bonds and cash. And they've moved into bonds and cash because they're fearful about the future. So you can see here that the 10 largest companies as a percentage of total market capitalization. Have a look at this. It's, there's about 2,000 companies on the stock exchange. The 10 largest companies make up 30% of it by value. Does anything else strike you as unusual about this from the top 10? The composition.
Financial services.
Yeah, the financial services. The financial services company, if you add up, make up 20% of the value of all the markets listed on the exchange. The Commonwealth Bank, Westpac, ANZ, NAB, and Macquarie Group. So to explain this, why is it that these companies are doing so well? Okay, this is a tutorial question, and there could be an exam on this, so this is one time you should pay attention to this graph. Let's say you have this efficient frontier here. This is the old efficient frontier. Okay. And on here you have expected returns and risk. So I want to ask, in a period of where everyone's concerned about the future and there's low aggregate demand, why is it that a few companies, large companies, are doing so well in the stock market? So to help understand that, we see here, this is the old frontier. Now, in this situation, in this old efficient frontier, we had a booming time, but there's a lot of confidence in the market. When there's a lot of confidence in the market, to invest in risk-free bonds, investors expect a positive return because they say, these are good times, we're confident. If we want a highly liquid stock, you'll still have to give us a positive return. So this might be something in the order of, say, 5%. And then they become fearful. There's a drop in demand, they're concerned about the future, so investors then decide, we rush into bonds. They become risk averse. So they start buying government bonds and the prices go up. As the prices go up, the expected return goes down. Now, if you're holding government bonds at that time, you'd have made a killing. Okay. So if you were already holding government bonds, as the interest rates decreased, the value of your bonds would go up. But for the people who bought the government bonds now, they're buying them, the returns go down, the expected returns go down, because they're buying them at a higher price. So you see the efficient frontier now, the first line goes up there. The people buying risky securities, they find it hard to raise cash. Their prices go down and the expected return goes up. So there's a pivot that comes over here. Now, if you're a company like a Commonwealth Bank, BHP, Westpac, ANZ, or National Australia Bank, you've basically got a monopoly. So when everyone else is fleeing all these risky companies, you're seen as a safe stock. Your equity is seen like a corporate bond. It's not so risky. It's effectively like a corporate bond. So equity of companies with high payout ratios that are perceived as low risk, they become more popular and increase in price. So this explains the paradox of a booming share market while at the same time we have very low interest rates and people are fearful about the future. So to give you an extent of how much fearful about the future, so we see that negative yielding bonds top $9 trillion as growth worries return. So Japan's equivalent back in negative territory, while the German bonds is teetering on the brink. Even in Australia, this is Bloomberg, which hasn't seen a recession since the 1990s, 10-year yields are now below 2% there. So it's a large stock paying frank dividends that are driving the ASX performance. So why isn't there sufficient aggregate demand for goods and services? So one plausible answer to change in modern economics, and so the concern is, will the decline in demand be long-lasting? So what Thomas Piketty, who wrote a book that was famous a couple of years back, lots of people bought it, not so many people read it, but it's a good... what he says is that return greater than growth is the problem. And so to give you a sense of what he means by this, I'll give you the take from these two people. So they've looked at, they're looking for zero negative interest rates, and this is back in 2015. So he expects rates will continue to move lower. And he says every year he travels to mainland China to see the pulse of the latest technology development, and what he sees has convinced him that innovation across economies will continue to put pressure on employment and wages there. Why? Because people are producing more and better goods with less capital requirements. Therefore, there's not the demand from wages. And there's not the demand for wages or workers as there has been in the past. So if you have a look at this from 2014, this graph, you see that some costs have increased, so things like education, childcare and healthcare. These are probably your biggest costs. But the things to make, things like television, toys, phones, have decreased in price relative to others there. So this iPhone is a fairly sophisticated thing, but it's really cheap to make compared to what it was before. I mean, it's remarkable that everyone can afford an iPhone. I remember, another anecdote, so I'll keep them down to a minimum. I'm cutting close to my maximum. But I remember going to India a couple of years back and going to the street and seeing this families on the street living literally nothing, but they had a mobile phone, which is, so it's kind of a remarkable thing. But, okay, to give you a sense of this, of the kind of change, so Macquarie, this is 2014. The employee numbers peaked in 2011. The company centralized support activities such as human resource, finance, and technology, and sent some of the officers to India. In 1995, General Motors made 4.5 million trucks in the US, employing 555,000 people. In 2009, General Motors sold 2 million cars, a bit half, but with only 777,000 US employees, 27 cars per employee. So again, much more efficiency, less demand for people. The world's largest company, this was 2014, total cash 147 billion. They only have 80,000 full-time employees. So what should governments do? So two things, and so this is the issue that people get excited about in the financial press. One is the government should stimulate demand by spending and so therefore run budget deficits. The other argument is to cut back on government spending and balance the budget. Here the point is, here they say that recessions are a symptom of the economy reorganizing itself, so we shouldn't intervene. The third response is that the monetary authorities should increase the money supply until investors choose to invest in risky assets in a search for yield. So I'm going to focus on these two, the first and the third. So one argument is, well, we're in a recession or there's insufficient demand, so governments should simply print more money and stimulate the economy. The standard argument is that you'll stimulate inflation or you'll crowd out private investment with high interest rates. So the government borrowing money will cause interest rates to rise. But the point is, the government has forced to think about this because there isn't any private investment and interest rates are low. Back in the old days, when the Republicans still cared about budget deficit, they used to worry about President Obama running all these deficits and everything. And the S&P threatened to cut the US credit deficit at this stage. What happened? Nothing happened. They cut the deficit, they reduced things, and the government was still able to lend. No one was really concerned about the US government's ability to repay its loan. Yeah. The US government can print as much money as it likes to repay any and all of its debt obligations. The fact that there are ultra-low interest rates for US government securities tell you that investors still willing to buy these, they don't lie awake worrying, oh, will I get paid by Uncle Sam? It just doesn't. So the problem here is this low interest rate. So you can see that the inflation in advanced economies is falling below trend. Why do economies like, this is an interesting, why do governments like to have inflation? If the money is completely stable, people end up saving their cash. Whereas if you have inflation, it encourages people to spend some of it. So a positive inflation is good for to encourage people to spend. So the big problem is deflation rather than inflation. So what's another solution was promoted by Milton Friedman, and I'm putting this up because Milton Friedman is a champion of the free market, so when people talk about the socialists and everything, the biggest proponent of this was one of the most influential economists of the last 60 years. So normally governments would increase spending by lowering the interest rates, but when you've come down to effectively zero interest rates, the only other thing to do is to print money, to actually push the money out there, because you can't lower interest rates any lower than zero. So you print money. And that's what Milton Friedman suggests. So he made the argument in respect of Japan, which was in a similar situation back in 1995, so they're much more advanced. They were where we are now back in 1995. And they said, we've got the interest rate down to zero, what more can we do? He says, if interest rates are zero, it's a sign of tight money. So they can buy long-term government securities, and they can keep buying until the high-powered money starts getting the economy in expansion. What Japan needs is a more expansive monetary policy. So this, Why is it that a zero interest rate is a sign of tight money? The answer to that is to think about, what is it a zero interest rate for? It's a zero interest rate for government securities. So if it's a zero interest rate for government securities, it means that people are willing to buy risk-free bonds, but they're not willing to buy risky assets. Okay. So when I say it's zero for government bonds, not for risky assets. For the companies that have real risks, no one's willing to lend to them. So what he's saying is, keep on giving them money until they get sick of zero interest rates and they're forced to buy riskier securities. You'll go through that in your tutorial. So he thought, but basically what he's suggesting is put up money. Okay, I'll stop now. I'll just there's one point, just in terms of just a broad, just one last slide I want to put up, and which is just to say that reading the financial press can often give you a bad sense of the world, but also other events can give you a sense that the world is coming, we're living in a particularly bad time. And so it's important to get things into perspective, which is not to say that some things won't affect you in terms of, just by virtue of their salience. But at times it's also really helpful to take a step back and not to focus too much on the immediate news. And in the interest of that, I want to say that we're not living in such a bad time now. So if you look at this, each day on average, 295,000 people gained access to electricity for the first time, 305,000 people able to access clean drinking water. Each day, an additional 620,000 people were able to get online. And this is continuing. So by the 2030, which isn't that far away, we'll be able to eliminate extreme poverty, which is a pretty good thing. All right. The password is, for the quiz, is Buffett. B-U-F-F-E-T-T, capital B. Can you access it? You can?
No, I wanted to do it while I was here.
No, that's okay. Lockie, can you access it? Can anyone else? Thanks. Try harder, Lockie. you.